Hi, everybody. Welcome to the Parallel Systems broadcast. I'm your host, Mike, and a big thank you for joining me for our latest episode. On tonight's show, I'm going to be telling you why you are the poorest you have been in history. And of course, I'm talking about people at the mean here, and I'm going to be looking at the minimum wage and also looking at why it's almost certain that the stock market is going to explode in the coming year. So, lots to get into. Let's go to our first chart. So, you can see in front of you, my friends, we've got a chart, and this chart comes from Fred, which is the St. Louis Fed Research, which is the research delivered by the Federal Reserve. Now, I'm always surprised at just how much data the Federal Reserve like to give away, even if that data shows them to be out and out criminals and crooks. But I appreciate it. So thank you very much, Fred. And this chart's extremely valuable, and I'm going to tell you why now. What it actually shows us is the true cost of inflation and the real minimum wage for US workers. Now, I haven't extended it all the way to today because I'm going to save that as a little surprise at the end of this. But first, let me just explain how this chart works. You can see there are three colored lines here. We've got a red line, we've got a green line, and we've got a blue line. Now, firstly, I'd like to draw your attention to the green line. You can see it kind of goes up in a step-by-step format, and this goes all the way back to 1950, and this current chart goes to around 2010. And what we're looking at there is the actual nominal minimum wage in the US. So you can see back in 1950, it started out at 75 cents an hour. Then by the time we got to the 1980s, we had that massive decade of inflation in the 1970s. People were losing the shirts off their back, and you can see it went all the way from $1.60 in early 1970. And by the end of the decade, it was up at around $3.35. And today it sits, or at least in 2010, should I say, it sits at around $7.25. Now you can see there's long periods where it's flat, and that's because, of course, Congress sets the minimum wage. They tell the US workforce what they're going to get paid for the minimum wage. And of course, minimum wage jobs are kind of the norm now. Most people are working in Starbucks when they leave university. They come out with a diploma in doggy dancing or transracial gender studies for frogs, and they've got this fantastic degree, and they take it to Starbucks and they get given a fantastic minimum wage job. Now, I'm joking, of course. There's plenty of people, hardworking people, who have minimum wage jobs. My first job was minimum wage. I actually worked in a fish factory cleaning up fish guts off the floor. So don't worry, my friends, I've been there and I've done it. And the reason it goes up step by step, like I said, is because Congress will do their darndest to not raise that minimum wage. They don't want you to be richer. They don't want you to have a higher standard of living. They want to keep you on the breadline. That's why they want you. Now let's go to the blue line. The blue line is fascinating, my friends, because what the blue line shows us is the minimum wage adjusted for CPI. So now we're getting somewhere. So it shows us if the minimum wage is actually truly going up, or if inflation is actually reducing the minimum wage in real terms. Because remember, if the minimum wage goes up from, say, $1 to $2, but inflation actually goes up by 120%, it means the person has lost purchasing power. Even though they got a 100% increase in their minimum wage, the actual inflation was 120% and they lost purchasing power. Now, this is really fascinating because when we get to the 1950 to 1960 period, you can see that people actually had their salary eroded. Although the minimum wage had jumped up, they lost purchasing power. But then something unexpected happened, something that I don't think any of us are expecting to see in the modern era, which is that minimum wage actually outpaced inflation. And this was going from 1956, 1955, 56, all the way up until 1970. Which, remember, is when gold was at a fixed price and we had this baby boomer generation. They got cheap housing, they got fantastic jobs, fantastic pensions, and actually their salaries were outpacing inflation, meaning they could buy excess things. And we see all those memes today where it shows you a young man and a young woman from the 1950s saying, "Darling, maybe we should have our fifth child and buy our third house." And then there's the guy from the millennial generation who looks all haggard and he's got hair all over the place like Jordan Peterson after a night on the... I'm not going to say that. I'm not going to say what just was going to come out of my mind. Sometimes I get this urge to say silly things, but you know what I'm saying. It shows you a millennial who is all haggard and saying, maybe I should choose today to buy dinner or pay rent or something along those lines. And of course, the further you go along this chart, the more you find that actually minimum wage has been falling. So now let's scoot forward a little bit and see where we are today. And this one's going to shock you. Well, probably not, because if you're from America, you know what's going on. You know it, and I know it. And it's the same in the UK, by the way. It's the same in Taiwan. Well, I don't know that. I've never been to Taiwan, but I'm guessing it's the same across the world, or at least in the Western world, because we are the most indebted nations. So let's do the big reveal. Let's see where we are today. Look at that, my friends. What you find is that the real inflation adjusted minimum wage today is not $7.20, which, bearing in mind, hasn't gone up since the great financial crisis. Where we are today is actually the lowest minimum wage in US history since the minimum wage began. So, just to reiterate, what we've got now is American workers earning less than ever before in history. And that's because of the ravages of inflation. And who's responsible for that inflation? Well, it's both Congress, who are the green line, and it's also the Federal Reserve, which are the creators of the chart themselves. So we've got this symbiotic relationship between the two. Now, if you're looking at that, if you're looking at people today earning equivalent $1.60 an hour equivalent to what it would have been. I mean, like I said, it's worse than it was back in 1950 when the chart began. It's no wonder. It's no wonder that people can't afford to feed themselves, can't afford to clothe themselves. And the best thing they can think to do with their money is to buy some Netflix and some junk food just to while away the misery of having not enough cash. Now, where we are today, of course, in America is we have a new president coming in who is promising to lift America out of the doldrums. It's promising to give the working man and woman a better future. But I'm not so sure about that, because I think America is in the worst financial position that it's been in history. And I'm going to show you why now. Okay, everybody, on to the next page, because I really want to contrast what we just saw in the previous chart, which was showing us the real minimum wage. And of course, it highlighted that the everyday man and woman in America is being stretched thinner than ever before. They're being paid less, inflation adjusted, than at any other point over the past 70 years. Meanwhile, we've got indicators telling us that the US stock market is at the highest overvaluation in history. And of course, the media, the financial media, the president, they say the US economy is booming, it's thriving, and they always point to the stock market as a good indicator of this. But I would argue that the everyday man and woman doesn't possess many assets at all. Most of them don't have any stocks unless it's in their 401k, which they're going to get sometime about never, because it's going to be gone long before they retire. So let's just try and figure out what's happening. There's a contradiction at play here. They tell us it's booming, but the previous chart tells us it's not booming. And I've got another really important chart to show you in a second that suggests we could be heading to the mother of all crashes. But first and foremost, let's look at one of the indicators that I was just talking about. This is the buffer indicator. Now, the buffer indicator is a very useful financial tool for understanding when the US stock market is entering dangerous overvalued territory and could be due for a major market correction. What it's actually doing is looking at the market cap of the US stock market and dividing that by current US gross domestic product. And what that shows us is when there is an aberration, when the financialized assets are becoming hyper overvalued in comparison to actual real economic production, gross domestic product. Now, I've actually got the chart in front of me, and what you can see is that the chart has literally run away with itself, and we are now at the highest reading on record. Now, this is really important because what this tells us is when the US stock market has become extremely overvalued versus actual production in the economy. It tells us almost like when a house is spending more than they are bringing in. Well, that's the US right now. They are spending more than they're bringing in. That's why they've got such high deficit levels. But the money is going into the stock market. It's not going into the pockets of the everyday man and woman. And they're going to stop spending. And that is why I think the US is already in recession. But let's go back to this chart. What you can see is that there's these big gray bars going down the screen. That's when the US entered a serious recession. And you can see that the buffer indicator was already signaling red in the build up to those periods where the US was about to go into recession and also have a major market meltdown, such as the 2000.com crash and the 2008 GFC. So where we are today is higher than both of those previous crashes, way higher. In fact, the only time it reached this level before was just going into the COVID crash. So this is a very important thing to understand, my friends. What they're telling you in the financial media is BS. And what the actual indicators are telling us is that we're heading into really dangerous territory. And I don't think we're going to make it through this year without some kind of reckoning that actually takes us back way, way beneath overvalued territory. And if it doesn't, it's because they're going to flood the system with more printed money. They're going to come to the rescue with a fire hose, flood the system with more liquidity. But I'll tell you what will happen after that. It will debase the currency. Inflation will come back with a vengeance. And that will only speed up our movement towards a giant financial reset, which is something I've been talking about for a long time on the channel. Now, the final chart that I want to show you is one that came across my screens today, and it's auto loan 60 plus day delinquency index in subprime and prime auto loans. Now, what this basically shows us is people who have taken out a loan to buy a car, and what they've actually done is not paid back their loan, and they're over 60 days in delinquency. Now, this is a really fantastic gauge for understanding when the average man and woman on the street are really struggling financially. So it's a good supplemental indicator for understanding when we're heading toward a massive economic reckoning, a financial crash, and potentially a greater depression. Now, if you look at the times when we've seen this chart spike, it was in the early 1990s, going into the 2000.com crash, it was going into 2008, it was going into 2020, and where we are right now is at the highest reading in history in terms of auto loan delinquencies in subprime auto loans. And we're talking a 60 plus day delinquency. So that's people who ain't going to be paying back those loans. Now, the highest reading in history right now, when you look outside, it doesn't seem like there's fire and brimstone. Well, it does if you're looking at some of the crazy weather events, which we've spoken about recently on the channel. But like I said, in terms of the economy, that's not what they're telling us. They're telling us it's all fine. But the indicators are flashing red left, right, and center. Overvaluations are in the 99th percentile, which means we are really in dangerous territory. There has never been overvaluations like this that haven't been preceded by a major market correction. And this chart is just backing up everything else that we've been talking about on the channel. Okay, buddy, just a few more charts to get through. This one is the personal savings rate. Again, a very important chart because it tells us just how much people are managing to save from their miserable salaries. Now, in this one, what you find is that going into 2020 and 2021, the personal savings rate shot up substantially. Why was that? Well, it's because people were being given stimmy checks. They were being paid to stay off work whilst that whole little panto went around and around. Now, of course, businesses were being paid as well to close down, and everyone was getting checks, and all of that money fed itself into the real economy, which led to huge inflation, which certainly contributed to the further erosion of salaries and the minimum wage. Now, what you find is that after that little period was over, the personal savings rate collapsed. All of a sudden, people could go out to eat and drink again. It was happy days, and they all forgot about that craziness that just happened. But all of the savings that they'd accumulated got wiped out. And where we are now is back below where we was going into 2020. We've also got people that are tapped out in terms of debt, delinquencies on those auto loans. And it's not just auto loans. Look at this one here. This is banks consumer loans. Again, we've seen a massive spike in delinquencies, way higher than it was going into 2020. This is all telling us something. It's telling us that what we're seeing in the financial markets, those huge overvaluations, are not justified, as the Buffett indicator shows us. That tells us that we're at the peak of a bubble at a time when people are more financially strained than at any other point over the past decade. That doesn't suggest to me like we're going to see a new wave of prosperity in the US economy. It doesn't suggest to me we're going to see higher and higher stock prices going into the next 2-3 years. In fact, I think it's going to be the opposite, and that's what I want to get across tonight. Now, the final one that I want to show you is delinquency rates on commercial real estate loans. Now, looking at this chart, you might be saying, Mike, This one doesn't look that impressive. All the other ones had those hockey stick moves that were showing us something significant. This one shows us a gradual uptick, but what you'll find is that it went from 0.63 in the middle of 2022, and where we are today is 1.5. So that means it's gone up 200% since then, and we've got a ton of commercial real estate that is going to have to be refinanced in the coming 2 years. In fact, it's trillions of dollars worth that are going to have to be refinanced in the coming 2 years. Now, the problem there, of course, is interest rates have risen rapidly and the US economy is now entering serious downturn. People who can't afford to save money, people who are defaulting on their loans, on their credit card loans, on their auto loans, they don't go out to spend. They don't have the savings in the bank. So, of course, that's going to feed through to the commercial sector, and the US is going to head into a great recession, if not depression. And of course, the consequence of that is going to be the whole thing will come down. In fact, now you didn't think we was going to get through an episode without me bringing out the Pyramid of Doom. Certainly not an episode like this. This is my Exeter's pyramid that I revised. It was based on John Exeter's original pyramid, but I changed it for the modern world. And you can see at the top, we've got 2 to 4 quadrillion in derivatives and unfunded liabilities. Now, you might be saying, Mike, that's impossible. 2 to 4 quadrillion. There is no way that a financial system can continue with 2 to 4 quadrillion in bets. There's not enough money in the world. There's not enough collateral in the world to satisfy that kind of catastrophic debt growth. And you would be right. At some point, those bets are going to have to come to fruition. That is why they cannot afford a market meltdown, because that will trigger the domino effect that leads to the unraveling of the derivatives complex. And those 2 to 4 quadrillion in bets, remember, there's somebody who has to lose. There's a winner and there's a loser. But of course, if one side loses, we all lose because the whole financial system comes down. So you might be wondering, well, where is the collateral on those bets? What if they just default? What's going to happen? Well, there is collateral. The collateral that's being put up for those derivatives is your bank deposits, your stock portfolios, your pensions, your bonds, your encumbered property, cars that have loans like the auto loans. We're talking mortgage property. All of that is being bundled together and put up as collateral to ensure that the financial entities at the top of the system, what they call the systemically important financial institutions, the very same people who made these bets, that they will be bailed out with your property, or what you assume is your property. Of course, it's not your property, because if you have it indebted, or even if it's not taken out with a debt, such as, for example, your portfolios of stocks and shares and bonds, it's beneficial ownership. And I've done many episodes on this before. And the way that you'd have to handle this, of course, is to not be in the market when this thing starts to unravel. My guess is that when this starts to unravel, they will come to the rescue one more time, that they will flood the system with liquidity. But I don't think it's going to be enough. I think the everyday consumer will only have a very slight reprieve, because what's going to happen is inflation is going to come back with a vengeance. Mortgage rates will shoot up, destroying property values. Commercial real estate will certainly unravel, because people won't have the money to go out and spend beyond that short period of stimulus, just to kick that can down the road one more time. And where you want to position yourself, of course, is to be on the other side of the debt trade. The other side of the debt trade is real assets that have no outstanding debt and no counterparty risk, because it's the counterparty risk that is going to destroy most people, as I just highlighted in discussing the collateral for the derivatives complex. Of course, if you're dependent on the state for liabilities, we're talking things like healthcare, Medicare, pensions from the state. Well, unfortunately, I don't think they're going to be there by the time it comes for you to redeem those promises. So I hope you found that one interesting, my friend. Clearly, we're going into some seriously dangerous times, and it's never been more important that you get yourself ready for what that could entail. In fact, I think this year is going to be one for the ages for many reasons. It's not just going to be financial, it's going to be geopolitical as well. So we have to get ourselves prepared. And if you enjoyed this episode, but you'd like some more information on what you can do to get yourself ready, check out my Patreon page or my Substack page, where you can find out how to better protect you going into these dangerous times. In fact, I'm going to be releasing an article this week highlighting how you can use a wealth preservation pyramid, and it guides you through those key steps of allocation in terms of assets to protect you and your family going into harder times, whilst also giving yourself the flexibility and liquidity to take advantage of the great opportunities that arise when most people are having to sell their assets at fire sale prices. So, with that, my friends, thank you so much for listening to this one. I hope you all have a fantastic rest of the week or weekend, and I look forward to seeing you all in the next one.